Good morning. I'm Tim Nyland, and today we are going to discuss the analytical framework for how long-term investors should approach a Zacks rank of sell. The reason we are going to discuss this today is that I received many questions about what to do when you see a Zacks rank of sell. I also received just as many questions about why Zacks rank sell stocks remain members of the earnings certain family, as well as the focus list. When we complete this webinar today, you will understand that not all Zacks rank sell stocks are created equal. Before we get started, please like, comment, and subscribe and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you would like to do the type of analysis you're going to see in this video, then you need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor tools and the Zacks Research System. Let's go ahead and get started. So again, we talked about this in a previous webinar. I'm going to explain it a little bit differently this go around. What is the Zacks rank and exactly why should we care about it? We're all aware that any revision in a company's expected future earnings directly affects the company's stock price. Zacks rank is a quantitative score based on the analysis of underlying EPS estimates contributed to our Zacks consensus. The Zacks rank seeks to estimate the statistical likelihood of either positive or negative consensus EPS estimate revision in the near term, and we like to refer to the near term as 1 to 3 months. As investors, we must pay attention to the messaging behind both Zacks rank buy and sell ratings. The Zacks rank gives us a powerful tool to anticipate stock price movements through the combinations of 4 underlying factors that I have on the screen. The image on the screen is actually taken right out of our Zacks Advisor Tools Zacks Rank Guide that is available for you to download. You can request it at the bottom of the page in our YouTube channel. The very first input is agreement, and that is the degree to which analysts have been revising estimates in the same direction. Second input is magnitude. This is the percent change in the mean EPS estimate from its recent past. Third input is upside, and that's the degree to which most recent estimates differ from consensus. And the final input factor is surprise, and that's the extent to which the last reported quarterly actual EPS deviated from the mean estimate of that same quarter's EPS. So a little bit of an elaborate explanation, but very important to understand exactly what we're talking about with the Zacks rank. And again, it's that statistical likelihood of either positive or negative consensus EPS estimate revisions in the near term. So what we're going to do today is we're going to discuss that long-term investors analytical framework for approaching a Zacks rank of sell. We're going to do this by comparing 2 of the most unlikely candidates. Something I love to do is take companies that absolutely have nothing to do with one another and draw conclusions and comparisons. And that's what we're going to do today. Taiwan Semiconductor and Dollar Tree, and I apologize, but it looks like I have their ticker symbols jumbled up here on the screen. So forgive me. If you do request the slide deck, I will fix this. Taiwan Semiconductor's ticker is TSM. Dollar Tree is DLTR. That will be fixed. And we're going to do this with the analysis of 3 fundamental drivers of a Zacks rank sell. It's these 3 fundamental drivers that are the analytical framework, and I'll be sure to explain this as we move through the process. Okay, so let's have some fun. Taiwan Semiconductor, everybody's seen this chart before. I just wanted to illustrate the Zacks rank sell, the fact that this thing has been sitting flat for literally almost 9 months. And this is the price and earnings chart out of the Zacks Research System. Okay, here's Dollar Tree, Zacks rank strong sell. No difference really for our purposes and what we're doing today between the Zacks rank sell and the Zacks rank strong sell. Just realize that the Zacks rank strong sell has a much stronger statistical likelihood of that EPS estimate revision continuing downward. That's the only difference. But from an analytical framework perspective, let's just consider Dollar Tree to be a sell as well as Taiwan Semiconductor, and you can see that up here off the price and earnings chart. Okay, so again, price declining with analyst estimates in retreat, and we'll look at this here in just a little bit more detail. So again, the framework is the three fundamental drivers behind the Zacks rank of a sell. Specifically comes down to these three things, right? Revenue growth. Are revenues increasing or are revenues on the decline, right? If revenues are increasing, we really have no issue. If revenues are on the decline, then we've got to determine if it's a cyclical decline, right? This would be a normal seasonal decline, which they might get a pass. Non-recurring decline, right? This will be a one-time decline due to something like COVID. Anybody that's been on a strategy session with me knows that there can be many, many reasons for these one-time declines in revenues. And so we need to be able to determine if that is in fact the case. And we actually have screens that can help us with that analysis. Or we need to determine if this is a sustained decline, right? Failing business model and perpetual decline. I've got many stocks that I've taken out of the earnings certain portfolio because they've decided to just wake up one morning and actually change their business model, and their revenues then fall into this sort of perpetual decline. So this is one of the companies, Stericycle, that I tend to mention on a regular basis, fell victim of that a couple of years ago, but there's been many others. So these are the fundamental drivers and the framework that we use as long-term investors to determine what to do with these stocks when we see they have a sell rating. Okay. The next fundamental driver is capital expenditures, right? So we have to separate the two different type of expenses. So the idea here is if we have a Zacks rank of sell, we know that the EPS estimates, the likelihood of them being on the decline or to continue to be on the decline from a forecast perspective is statistically likely. Okay, so it's either going to come down to revenue growth, but if revenues are increasing, then we must have expenditures on the rise. And those expenditures are either going to come in the way of capital expenditures or operating expenditures. So that's 2 and 3, right? So capital expenditures are very, very different, right? This is an expense that a business incurs to create a future benefit. So capital expenditures are fixed asset purchases, intangible asset purchases. These purchases are booked as long-term assets, and they build operating leverage over time. The idea being that we would expect that purchase to increase capital efficiency and profitability over time. Okay, that's different from an operating expense. An operating expense is an expense required for the day-to-day operations of the business. These expenses are expensed when they occur, and they do not build operating leverage. So when we see a Zacks rank of sell, we immediately need to be able to answer what's going on with revenue growth, what's going on with capital expenditures, and what's going on with operating expenses. And this is the framework. So what we're going to do is we're going to pick up where we left off last week with Taiwan Semiconductor. And again, this is from the September 8th, 2020 webinar, 10 reasons why semiconductors aren't leading the NASDAQ 100. From slides 19, 20, and 21, if you remember, we focused on EPS estimate revision decline, free cash flow after dividends, and how that negative free cash was being funded. So we primarily focused on cash flows, and then we just briefly showed what was happening with the capital structure in terms of long-term debt to fund those negative free cash flows. So we're going to bounce through that as a quick review right now. If you recall slide 19, reason number 8 of 10 was the cost of fabrication capacity building out was actually hitting the FY1, FY2 forecast. Now, keep in mind, this is all the while revenue growth is still growing by leaps and bounds. I mean, there's obviously huge demand for Taiwan Semiconductor's products, right? But this Zacks rank of sell is accurate, reflecting both that R&D and capital expenditures hitting the earnings. It's large. We've got Taiwan Semiconductor committing to spend over $100 billion over the next 3 years to build out their fabrication capacity. So you're seeing that now show up in the estimates, and that's one of the reasons why the stock has kind of stalled out. Okay. Slide number 20 was reason 9 of 10. Cost of fabrication capacity is obviously hitting cash flows, right? So we see the CapEx ramp up here, and we can see it actually driving free cash flows after dividends negative, okay? Now, we go to the next slide, slide 21. This was reason 10, that free cash flow burn rate after dividends was being financed, obviously, with long-term debt. And this is where I pretty much ended the webinar last week, was showing that Taiwan Semiconductor has really leveraged up their balance sheet in order to fund all of this fabrication capacity build out. And that's what we would expect, right? So capital expenditures obviously on the rise massively, contributing to negative free cash flow after dividends. And you can see that cash from financing, that injection of long-term debt, really helping to prop up that change in cash and cash equivalents. And that's what we would expect. Okay. Now we ask the questions, right? What do you do when you see this type of ramp up in capital expenditures? I want you to ask the following. Is a dollar invested in this business generating more than a dollar invested in the marketplace? And when we say marketplace, let's just call it the S&P 500. You guys have seen me do this all the time. I love my return on capital chart where I use the S&P 500 composite relative to whatever stock we're looking at or other composite. But in the case of Taiwan Semiconductor, the answer to that question is yes, and by a factor of almost 2x. Return on capital for Taiwan Semiconductor over the years has pretty much averaged about 2 times that of the S&P 500, and you can see that S&P 500's return on capital right now, on average, about 13.67. Taiwan Semiconductor is averaging about 25%. Okay, so the next thing we need to do is we need to define what value creation is, right? If we've got a sell rating on Taiwan Semi, we need to understand what's going on. Taiwan Semi creating value. The idea here behind defining value is that we all have heard about this cost of capital, right? So there's a return spread in excess of cost of capital, and then we need to add to that the dollar amount a company can invest. Well, we already know that Taiwan Semiconductor can earn a return on capital that's nearly 2 times that of the S&P 500. So let's assume that return is in fact greater than cost of capital. And then obviously the $100 billion investment that they're committed to over the next 3 years, we know that has the ability to potentially deliver operating leverage when that fabrication facility does come online. I should say facilities. Do not forget these risks though, right? We reviewed these last week. Geopolitical risk with China, oversupply shock, right? We've got Intel and Samsung also building out massive fabrication capacity. We don't know what that global macroeconomic environment is going to look like in 3 years. What happens if we hit a recession at the same time everybody's fab capacity comes online and we can't give away these semiconductors? There's risk here, okay? So we need to be careful. So let's dive into this a little deeper, right? Just kind of walk you through the framework. You're going to really come to appreciate how the financial statements are actually set up inside the Zacks research system. This is my design. I brought this to Zacks many, many years ago. And there's a specific reason for it, and you'll see it in just a minute. So let's look at the income statement, right? The beautiful thing about the research system, you can click on any of the headings here. So I just click on revenues, and it actually gives us a chart. And you can see that revenue growth remains intact, right? You'll see that we have a little bit of seasonality in here, but all in all, this revenue growth has just been charged in the hill. And you can see it's basically 28% year over year for the latest quarter. And you always want to look at those year over year rates as a way to eliminate seasonality. Okay, so revenue growth remains intact. So we've just checked that first box of the framework, right? So now we need to take a look at if they're making any investments in fixed assets. Well, we already know they are. And you can see the net property, plant, and equipment. This is where the capital expenditures are coming in, right? So we're building that asset base. We're building that operating leverage. The idea is at some point when these assets come online and they're able to produce chip fab, that we're going to make a return on this fixed asset, okay? So the next item we would want to look at is total assets. And again, I'm just literally walking down the balance sheet, net property, plant, and equipment. Notice intangibles are basically flat. I didn't even bring that up. So nothing in the way of intangibles, but it's just it's total assets. If Taiwan Semiconductor were making massive acquisitions to help fund this build out, then you would see potentially intangibles rising as well. We're not seeing that, right? So again, let's just focus on total assets here, rising at roughly the same rate as the net property, plant, and equipment. So the bulk of this being capitalized on the balance sheet in terms of CapEx. and showing up in the form of net property, plant, equipment, and total assets. Okay, so we're building massive amounts of operating leverage. And we can evidence this. Okay, this is what I love to do as well. Just make sure that your capital efficiency and profitability ratios also back what we're seeing on the income statement, on the balance sheet, and the statement of cash flows, right? So I would expect to see return on assets, return on capital, and free cash flow, return on investment on the decline as of late. Why? Because in each of these ratios, right, the common denominator is getting larger, and we have not brought that capacity online to generate those returns. So we're not getting a return on those assets, even though those assets have now hit the books. So you're going to start seeing this stuff roll over. Okay, this is what we would expect when we're building operating leverage. Okay, so here's some tips for approaching a Zacks Rank sell for long-term investors of Taiwan Semiconductor, right? So the idea is, wow, you see Taiwan Semiconductor, you've got a bunch of it in your portfolio, and you're like a deer in the headlights. What do I do? Well, we just concluded that Taiwan Semiconductor's EPS estimates are in fact under pressure because they've increased their capital expenditures, and they're outpacing, those capital expenditures are currently outpacing their revenue growth. And we can see that in the estimates, right? So these expenses are being capitalized on the balance sheet, and we do expect these expenses at some point to provide benefit in the future. So we need to weigh the time horizon against the amount of time it's going to take to begin benefiting from that operating leverage build out. So it's your time horizon against the amount of time it's going to take. We already know that it's going to be at least 3 years for Taiwan Semiconductor to get all of that fabrication capacity online. Some of it may happen sooner, some of it may happen later. We just don't know. It's too early to tell yet, right? So the Zacks Rank sell is basically telling us that the EPS estimate revisions may be under pressure in the near term, which could negatively impact the stock price again in that short term 1 to 3 month time frame that we like to refer to the Zacks Rank. Okay. So there's also things to consider if you currently do not own the stock, but perhaps you may be interested in acquiring or starting a position, right? The Zacks Rank is basically telling you that you might get a cheaper entry point at some time in the next 1 to 3 months should EPS estimates continue to be revised down, and that would make sense, okay? Again, we never ever want to forget the additional risks, right? Because the Zacks Rank is literally just talking to us about estimate forecasts. And if the underlying estimates themselves aren't incorporating in any geopolitical risk, the potential for oversupply shock or a recession in the next 3 years, these are additional items that we as long-term investors need to consider for our own risk tolerance, okay? So the next stock we're going to talk about is Dollar Tree, right? We're going to do a complete 180 and talk about a company that has absolutely nothing to do with semiconductors, Dollar Tree, discount retailer. Zacks Rank strong sell, right? It's accurately reflecting a decline in those EPS forecasts. You can see that's on the decline. It tells you that there's a strong statistical likelihood of further consensus EPS estimate revisions to the downside in the near 1 to 3 months. So this trend could in fact continue. So that's why we have a strong sell. Keep in mind that strong sell only happens to 5% of the Zacks Rank coverage universe. And you could conversely say the same thing about a strong buy. So a very, very exclusive class. And the idea here is not to scare anyone, but just remember the messaging that we need to pay attention to with any Zacks Rank buy or sell. Okay, we need to pay attention to what it's trying to tell us. So consider it a red flag and something we need to investigate. So again, recall the framework, the 3 fundamental drivers behind the Zacks Rank sell, right? We've already been through this, but I wanted to reiterate, we need to look at revenue growth. Is there revenue growth, or are revenues on the decline? If they're on the decline, why? Is it a cyclical decline, non-recurring, sustained? Capital expenditures versus operating expenditures, right? We're not going to go through this, but I did want to recall the framework. Now, I promised you some other views here that I love to use, and many of you have been on strategy sessions. You'll know this is probably my second favorite view in the system. At times, it's definitely my favorite view. This view is absolutely incredible for slicing and dicing revenue growth and margin type issues. That's exactly why it's called growth and margin, and it can be found beneath the financials menu in the Zacks research system. Whenever I bring this view up, the very first place my eyes go is over here to the right to take a look at what's happening with the capital structure. And you'll see that there's a forecast share buyback here that's projected to get really aggressive here in the October and January 22 quarters. And it's actually ramping up from 3.6% to 6.7, 6.4. So the idea here, since we've had a sustained share buyback and it's ramping up, is that we cannot utilize the diluted EPS numbers when making our comparisons of near-term growth relative to long-term least squares trend rates. Okay, we can't do that because the growth rates are in fact distorted, and you can actually see this in the numbers. Just in the latest quarter that was reported for July 21, you can see that the EPS that was actually reported was a 12% year-over-year percentage change in EPS, when the actual in aggregate, if you eliminate the share buyback impact, was only 8%. So I'm going to ask everyone to just visually put just a big red X through the diluted columns in both revenue and EPS. And that's exactly why you see my aggregate revenues and earnings columns marked up for you on the screen. I'm not even paying attention to the diluted because of the share buyback. Okay, so red flag number one. Okay, now the next thing that we need to look into here is what the overall trend in revenue growth has been. So this is the year-over-year percentage change on a quarter-to-quarter basis. The items in green here, these dates in green, these are all your forecast 4-quarter periods forward, and then you have your forecast 4-quarter total here. Okay, so the very first thing I want you to see is that prior to COVID, we had normalized growth right around 4.2, and then we really ramped up. So we brought a lot of demand for dollar store retailers forward, and you can see now we're trying to normalize that revenue growth out. And you can see that it is normalizing out, right? So this is totally normal. We've got normalized revenue growth. So it appears as though we've got nothing wrong with top line growth. And we can evidence that by the fact that we've been able to sustain these same 5-4% growth rates that we're looking at here for trailing 12, as well as forecast 4 quarters forward at roughly 5 and 4 over the 1, 3, and 5 year timeframes. I've got the 3 and 5 year timeframes highlighted here. But we get something a little bit different when we look at earnings. And again, I'm just looking for red flags, right? So it looks as though we've had earnings in decline, so perhaps some margin issues even before COVID. And then all of a sudden, we just broke out, just tremendous growth, right? A lot of margin expansion took off. We actually got margins all the way up to 7.4%. You can see that net margin BNRI right here. And then, so if you look here, I've got this trailing 12 margin of 25, and that's just going to kind of begin to normalize that out. Again, we're going to get 2 quarters of post-COVID in with 2 quarters of COVID. But you can see what happens here. We've got large growth numbers normalizing out, and we go all the way from a positive 25 to a negative 21, and that's nowhere near our long-term least squares trend rate for earnings of 4 and 9% over 3 and 5 years. So I have up here a note, margins appear to be under pressure. We really can't draw too many conclusions from this other than this is something we need to follow up on. So we do, right? So we're going to go to the financial statements. Very first thing we're going to do is we're going to focus on those expenditures, right? We're going to look for those capital expenditures. And I just went right to the cash flow analysis, clicked on the chart. I can see that there's really no ramp up in CapEx that we would be worried about capitalizing on the balance sheet. So we're not going to even have to worry about that. However, I do go ahead and look at the balance sheet just for further evidence. Perhaps I've missed something. So I look at debt, I look at intangibles, I look at total assets, and I also look at the common equity side, basically the shareholder equity section. And you can see that all of these, if you just look at them from a year-over-year trend perspective, just looking at percentage change and the actual dollar amounts, they all appear to be fairly stable. So I'm just looking for red flags. I'm looking for huge numbers that are out of alignment. I'm just not seeing any in here. The next place I go to is the income statement. And I did notice that I had a year-over-year percent change in gross profit that was negative when my year-over-year percent change for all of the prior quarters had been substantially positive. So this caught my attention. So I clicked on the gross profit, and I can see that I'm at a cyclical low, basically a trough at the bottom of a trough for gross profit. So this is another red flag we need to look into. And then this is where it gets fun, right? We throw our analyst hat on, and you'll see exactly why I have these financial statements set up the way I do. Remember that basically we have three things that we're looking for in terms of drivers for the Zacks rank of sell, the fundamental drivers themselves, right? So we've got revenue growth. You can see that here. And we've also got capital expenditures, and we have operating expenditures. And you can see that in this particular income statement, I have the financial statement itself transformed to common size. So everything is in terms of percent of revenues here. So what we're looking at is actually gross profit, but the percent of revenue column is actually your gross margin. So we've got the profit, we've got the margin, we've got EBITDA, right? Earnings before interest, taxes, depreciation, amortization, and we also have EBITDA margin. And what we can do is we can compare this year over year, okay? Just literally go back to the 731 of 20, compare it to the 731 of 21. And I have gross profit here highlighted in red for a reason. Now think about this for a minute, right? When we start thinking about the three fundamental drivers of a Zacks rank of sell. Cost of goods sold, right? That was basically listed as one of the operating expenses, along with SG&A and R&D. Well, isn't it interesting that when you remove cost of goods sold, SG&A, and R&D from revenues, you end up with EBITDA, and we call EBITDA our operating margin? Well, that makes sense because those are our operating expenses, right? When you remove the depreciation and amortization portion, again, that's the expenditures of that capital expenditures portion that actually hits the income statement each quarter, then you get your EBIT margin. But what I want everyone to pay particular attention to here is that we've actually got a decline in gross profit from a year ago. So a year ago, we were at 30.5. So now we're at 29.4. And that's telling me that we've got basically cost of goods sold as a percentage of revenue that is much higher. So we've got some sort of cost pressure taking place on cost of goods sold. So we're going to need to investigate that a little bit more. What's interesting is the magnitude of this, right? Because EBITDA actually improved. The EBITDA margin went to 9.1% versus only 8.7%. And that's even in light of gross profit margins slipping. Same thing with EBIT margin. We actually improved by 30 basis points, 6.3 versus 6.0. So I have these in green for a reason. I have this one in red. Here is our issue, our analytical issue of relevance with Dollar Tree, okay? So what I did very quickly, it only takes minutes to do, is I just consulted the Zacks analyst research, and it was right at the very top in the summary, first page. It actually highlighted exactly what I found, right? Its shares have witnessed a downtrend due to the expectations of elevated freight costs. Higher freight costs impacted gross margin, right? Freight costs go into cost of goods sold. Company expects higher freight costs to persist through fiscal 2021. Consequently, it slashed its earnings view for 2021. That's what we're seeing in the estimate revisions going down. That's why it has this Zacks rank strong sell. All the analysts were revising as the company was offering up and issuing this guidance. Here's the clincher. Lower SG&A expense more than offset the decline in gross margin, thus aiding operating margin and the bottom line. Well, isn't that interesting? We just concluded that, right? Here's our operating margin, right? We can see SG&A up here improved. And that's what actually contributed to that 9.1% operating margin versus the 8.7, even though we had so much cost pressures. Now we know what it's from. It's from freight costs hitting the gross profit, right? So cost of goods sold as a percent of revenues escalated from 69.5 to 70.6, driving down gross margins from 30.5 to 29.4, but we actually saved on SG&A and R&D, which allowed our operating margins to rise to 9.1. Okay, that's exactly what this is telling us. And we can confirm this further by going into a company press release, right? So the company press release, again, confirms the Zacks analyst research. I always like to just keep digging. It's incredible what you can find. The decrease in gross margin was driven primarily by higher freight costs, right? So again, the Zacks analyst research nailed it. It's right in the company guidance, and that's what you would expect, okay? So Again, tips for approaching a Zacks Rank sell for longer-term investors of Dollar Tree, right? And interestingly enough, if you didn't catch this, Dollar Tree is a member of the earnings certain portfolio, right? So this is of obviously particular interest to me. Dollar Tree's EPS estimates are under pressure because gross margins are under pressure due to increased operating expenditures, right? These are only expected to last through fiscal year end, right? These expenses are expensed as they are incurred, and they are not expected to provide benefit at some point in the future. So these are totally different than capital expenditures, okay? So things to consider if we own the stock as a long-term investment, right? We do, right? This is a member of the earnings certain portfolio. We don't necessarily trade the earnings certain portfolio. It is a long-term investor. And unless it is in a long-term investment, so unless there is some, systemic change to the business or some shift in expenses or something that's causing a major change to the overall business model, then I will have more of a tendency to look through this because our time horizon is so long, right? And we know the sustainability and supportability of Dollar Tree's growth, especially from an earnings perspective. It did not become an earnings certain stock without having those qualities. So again, things we need to consider if we own the stock as a long-term investment. We need to, again, weigh the time horizon, our time horizon, against the amount of time it's going to take before the company can resolve the operating cost issues, right? These are freight issues. Obviously, the company is aware of them. Management just disclosed them and gave guidance to it. So the Zacks Rank sell is telling us that the EPS estimate revisions may be under pressure in the near term, which could negatively impact the stock price in the short term. And again, we like to refer to that as 1 to 3 months. This is really, really good information to consider when you see a Zacks Rank sell to understand exactly what's going on at Dollar Tree. So things to consider if you do not own the stock, right? The Zacks Rank sell is basically telling us that we may get a cheaper entry point at some time in the next 1 to 3 months should those EPS estimates continue to be revised down. So the conclusion here is that obviously not all Zacks Rank sell stocks are created equal. So we need to continue to use this framework, right? So point number 1, right? Zacks Rank 4 or 5, this is going to be your sell or strong sell. This tells you that based on the underlying analysts contributing to Zacks consensus EPS, there's a strong statistical likelihood of negative consensus EPS estimate revisions in the near term, and that's 1 to 3 months. Point number 2, approaching any Zacks Rank sell stock with this effective framework can literally be boiled down to one question. So you can literally take that whole page and boil it down to one question, right? And that question is right here. It's absent a consistent decline in revenues, right? Because that would be disastrous. Are increasing expenses due to capital expenditures or operating expenditures, right? So again, declining revenues need to be considered a major red flag. But when it comes to what other items could contribute to a decline in EPS estimates, then we need to start looking at expenses. And we need to classify those expenses between capital expenditures and operating expenditures. Capital expenditures, obviously, being the ones that can be capitalized on the balance sheet, and we expect those to provide some benefit at some point in the future. And that brings us down to point number 3. We learned that with Taiwan Semiconductor, right? Taiwan Semiconductor's EPS estimates are under pressure because of their increase in capital expenditures. I mean, they are massive, and they are outpacing current revenue growth despite the demand for their products, okay? So again, we are expecting there to be some benefit, some sort of compounded benefit to be exact, on those capital expenditures in the future. Point number 4, Dollar Tree. Those estimates are under pressure because gross margins are under pressure due to increased operating expenditures, right? Those freight costs. Those are expected to last through fiscal year end, right? Operating expenses, again, are expensed as they are incurred and are not expected to provide benefit at some point in the future. So in the case of Dollar Tree, is this likely to cause a material shift long-term in their business model and change their overall business for the worse? The answer is obviously probably no. But at any rate, it is still a Zacks Rank sell, and we need to pay attention and understand exactly what is driving that Zacks Rank of sell. because it can be material from time to time. Okay, that's about it for this week. Thank you all for attending. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with advisor tools or the Zacks research system, or if you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and zrs@zacks.com. Feel free to reach out to any of us for a copy of any of our slide decks. And thank you all for watching, and I'll talk to you next week.